This correction is not over.
The stock market needed a pullback.
September's the worst month.
There's a tremendous buying opportunity.
Are you worried that we might see a new wave of inflation with all this strong data?
No, I'm not. Let me tell you why. Last year, we hired almost 5 million new workers, and we got GDP growth of less than 1%. It was the worst productivity performance in over 70 years. This year, we are hiring at less than half the pace, and we have 2 to 3 times the level of GDP growth that we had last year. Why is that? One of the biggest bounce backs in productivity that I've ever seen. That's why we could have this tremendous GDP growth and yet still have the disinflationary trends that are in the economy. Oil stopped going down, commodities have stopped going down. I see the productivity as being a basic deflationary force that will keep that inflation in check.
I get it, but we still have a tight labor market, and that is pressuring wage growth higher. In the past, a 2% rise in the unemployment rate was required to bring down wage growth by the amount that is needed today. But
wage growth is productivity. If the worker is actually producing more, then he or she should be getting paid more. So if we have 2 to 3% bounce back in productivity, and we have at least that would actually justify wages being 2 to 3% higher. And also, we have a catch-up. Even though the last year over year, real wages have increased, since the pandemic in March of 2020, real wages have fallen behind. Especially, you take a look at the UAW. They were under 3-year contracts, 3% a year. Well, when you have 9% inflation, you're going to fall behind. They're asking for some payback for the lost real income. Yeah, that's going to hurt the profits, Ford and General Motors and several others. But nonetheless, I think in many ways they deserve some of that payback, and they deserve a growth in productivity. So I'm not as worried about the wage growth as Powell seems to be, because I don't think that actually means a new inflationary spiral.
Maybe the economy is reaccelerating. Maybe it's a little bit too quick. Maybe rates have to go higher on the long end, and can stocks handle that? I mean, you could also just say that the stock market needed a pullback because of the run it had before this anyway. But how does this all play out? Because it seems like higher rates than the economy can handle means we all of a sudden might be looking into next year for saying, do we really have to choke off growth? Does the Fed have to do more? Or will rates themselves tip us into a downturn?
Real interest rates are very linked to real GDP growth. The acceleration of real GDP growth means higher real interest rates, and therefore higher nominal interest rates for any given rate of inflation. Why is that not tanking the stock market now? Because real increases in productivity and real growth increase profits. So therefore, we have that great battle between the numerator and the denominator of what gives us stock prices. Profits in the numerator look a lot better than they did 3 months ago, even though that denominator has gone up. So the bond market has not done well. The stock market is holding its own.
And you think it can continue despite this wobble?
I think it could continue. Now, this is a big increase in real rates, justified, I think, by the increase in growth. I do think that, Chairman Powell and the Fed have to be very two-sided. If they see a slippage of that productivity growth and any sort of increase in initial claims, he has to think about not only holding, but do I have to decrease the rate? Don't forget, we are going into political season. I guess you could say we're in political season and have been for a long time. Pressure is going to be mounting not to get a bad employment print. And he needs a dual mandate. So I think that he will be responsive, certainly more than I thought that he would be 6 or 12 months ago.
This correction is not over. Why do you argue today that this has more to go?
The confluence of evidence would support that there is more to go because of seasonality for the first point, meaning that we're in a bad seasonal stretch. September's the worst month. We also know that momentum has turned decisively negative in the near term on a tactical basis. And then breadth, meaning the number of names that are trading above their 50-day moving average, it's not washed out yet. So there's still likely some churn and digestion question to go. We've crossed under the 50-day. There's still likely support at that August 2022 high around 43.25, and then we'll see how we deal with that support level.
What do you make of this change in mentality from buy the dip market to what has now become maybe a sell the rip market?
I think the first thing to acknowledge is that it is very tactical. So as a strategic long-term investor, this shouldn't really change from what your plan is. But I think we can put it in the context of the 50-day. Prior to this sell-off, we were trading above the 50-day. Every time we traded down, April and May, we bounced right off of it. Today is different. We're likely going to be in a period of a little bit lower highs, lower lows, as you see people sell into strength.
Until Apple, biggest stock in the market, the worst mega cap this month, and the 10-year yield, which continues to creep higher, until those two things stabilize, we're going to be having similar conversations.
Yeah, I think that is hypercritical. And if you look at Apple alone today, that broke below its 100-day moving average, which means it puts its 200 days in sight for the next level of support. And Apple being such a behemoth and such an important part of market psyche, it's hard to imagine this market pressing much higher without the contribution of Apple and the other tech names, which have been trading weak as well.
Mega caps and technology were the leadership. You can't lose leadership and expect the market to fight up against what is obviously a historically weak seasonal period. Talking about close to 16% of the S&P trading below its 100-day moving average. We're in that seasonally weak period. And I think the question becomes this. If you were a 2022 bear, you believe this is the beginning of a deeper decline back towards the October lows.
Well, most of the 2022 bears have been 2023 bears.
Okay.
Because they missed it. They weren't positioned correctly to take advantage of the big run in mega caps that we had, which have saved the market.
Correct. And if you're a 2023 bull, which I am, you believe that ultimately at some point, not now at all, some point as we move to the back half of September into October, there's a tremendous buying opportunity. If you go back, Scott, over the last 33 years, there's been 10 instances in which the S&P 500 in the first half of the year rose by 10% or more. In each one of those 10 instances, the second half of the year was positive. If, in fact, that is going to be the setup as we move into the fourth quarter, you're going to have one heck of a chase for performance because all those 22 bears, they have to come around at some point.
So you're part strategist, you're part historian, you're part technician, right? You view the market through so many different prisms. What about the one that Joe puts forth?
This correction, as of right now, is not about growth fears, and that's very different from 2022. 2022, we saw EPS revisions go down 10%. We saw the weak recession or the weak GDP quarters that we had, so people had a kick up in recession fears. You don't have growth fears when Atlanta Fed GDP now is at 5.8%.
Right.
This is about yields, and this is about valuations, which is why the highest valuation parts of the market are underperforming.
The whole reason we got here in the first place was multiple expansion from the very names in which you're referencing that have pulled back over the month of August.
If you look at for the S&P 500, the entirety of the move this year has been multiple expansion, anticipating a better earnings environment. The thing that has been the most surprising is that despite the fact that we've had a recession call or no recession, no landing, a boom, a banking crisis, earnings estimates for the entire year have been static. They haven't moved. And so all the volatility is driven by valuation and multiple, which makes it susceptible to moves in yield.
Flat is the new up, maybe, for earnings for a while.
Yes, and I think that is the big contrast to 22, which was all about earnings coming down. So I think watching 2024 earnings to see how, if they get revised higher because of this GDP growth, that can offset some of the multiple compression. But we do have to remember is that we're pressing into this new high for yields, real yields, and at near peak multiples, that is a challenge for these high-flying names.